Happy Friday, Pat.
Hey, Rick, how you doing, buddy?
We made it one more time. We're back on for give people our nice little real estate update. So I'd let the audience know that we're going to change up the format here a little bit. Here's how it's going to work. So we're going to start out with just inventory numbers, where we're at, and then we're going to jump right into lending updates. And then we're going to look at some Cromford market data, and then we're going to finish it up with some summary and some Q&A. That way everybody knows where we're headed and there's no guessing, and they can fast forward if they want to go to the lending data and so forth. So, but you can't fast forward when we're live, right?
No.
So, so that's the party. What do you say?
Sounds good.
All right.
Nice segmented, ready to roll.
Let's get started. So the inventory numbers today, boy, for a Friday, Pat, 5,260. That's pretty low for a Friday.
Yep. Yeah, it's same old stuff, different day, same, different stuff, different. Well, same stuff, different Friday.
So we had over the 7-day moving average, 3,747 new homes get listed, and we gobbled up 88 more than that, 3,845. And it looks like this. So the interesting thing that I see in this chart is that our purchase line under contract is bumping up higher than last year, or I mean the earlier part of the year, and kind of right where we were in January of last year. See that right there?
Now the red line is once again
the red line's the number of listings under contract.
Okay, the blue
so the number
is,
that I gave you that was 3845. That's right here.
Okay.
So I tried adding data labels to this so you could see the numbers, but it just ends up being a really funky, busy eye chart. It's pretty rough. So the number of listings coming on board right now are not happening. So we're going to talk a little bit about that when we get into some of the Cromford market data. But before that, what's going on in the lending world, Pat?
This week was obviously a pretty interesting week. We saw the Feds come out to talk about their what they're going to be doing on Wednesday. And let me share the chart if I can find my mouse here. Share screen.
The market was pretty volatile this week, wasn't it?
Yeah, well, it really was. It really was. Let me see if I can share this one. See if that works.
You got it.
Yep. This is where we saw. Let me get the mouse over. Where is my mouse again? Since you got 3 screens, it's hard to find your mouse.
There you go. You're right there.
So this we saw December. We saw this run up the last. Just give people an idea, because obviously, the average person doesn't really, they hear rates are going up. This kind of gives you an idea of the volatility of rates on a day by day basis. I mean, they shot up obviously January 3rd, and I'm going to break it down. I'll break it down here even a little further. I mean, this was December. They had obviously rates really did make a move on January 3rd, and they made another move January 14th. And January 26th was Wednesday, and we saw the bond market down about 62 basis points in price. So this is rates moving up. I mean, this is a big move. And this right now, obviously the Fed's announced right here. So now, as you can see, I mean, the market is trying to find another base. I mean, there's a gap right here. I mean, I'm some technical, but these are technicals, but 189. If it breaks 190, we might go to 2 on the 10-year bond. And there's a floor here. So you can see how this bond market stays within these trends. You see a trend. Now it's just trying to find its level. I think watching the Fed, I think bottom line is this, Wednesday, there was this kind of like this, oh my God, here it comes type of day. And you saw the market kind of just obviously kind of go nuts. What's nice here is it kind of found a nice little bounce back. It started coming back down again. So that was kind of a good sign, because obviously if it would have been going up here, that would have been, short term. I don't think that would have been good at all. So it's trying to find a level. I think the secret is now out about the Feds doing something. Either they're going to do something in March, either quarter point, and I think the secret now too is out that they might be a half a point. So now that they're talking about it, you know, I saw that comment.
Yeah, they're. I mean, the numbers are already baked in, but then the
Yeah,
Fed came out and confirmed it, and so
yeah,
they went up a little bit more.
yeah. I mean, you saw this right here. I mean, obviously, the Feds, the market was kind of telling you that the Feds are going to do something, rising anticipation. And so that's what, when people say, oh, I saw the Feds just increase rates. The Feds weren't, there was talk about that. They weren't doing anything here, but here's the day that they announced it, you know. So now it's kind of like, I guess an example, kind of a stupid example, you're married and the wife or the husband, you kind of both know that might get a divorce, but you haven't talked about it yet. But finally, that one kitchen table day, like, okay, we're going to get a divorce. And then now, okay, now we know we're going to get divorced, but now we just got to figure out the details. Does that analogy make any sense?
In a wild, different sort of way. Yeah, I can relate to that. Or when you see things, certain files getting put in a different box for some reason.
Yeah. So now the Fed is, it's not kind of out there now. Some choppiness here the last week or so. I mean, you look back the last 3 years, obviously this is our trend now. I mean, this is back in 2019. We're at about those levels. I mean, if you draw the line across, this is, obviously, another thing is too, I mean, you got to keep in mind, I don't know if I can find this chart real quick here, but I mean, give me 1 second if I can, I can't find this. I don't know where this chart. Wait.
You were telling me the other day about some of the other banks have actually popped up to 4.1. And if you took some of the rates that you have with the lenders you have, and you put out a loan of 4.1, didn't you say that you could actually give them a seller credit of $12,000?
Yeah, just depending on the program, it could be anywhere from I was seeing differences, like I said, if I was to compare my rates, the broker rates to the banking rates, like I said, the banks are going to be, I think they're going to be in a tough sled because they've got fixed cost structures. I'm obviously a broker. I don't work for any particular bank, which is nice. That's when people shop, whether it's me, certainly a mortgage broker would be the way to go now with the volatility in rates, because I'm not locked into any one particular XYZ or ABC bank's rates. I could shop 30 different rates. So if I don't like this XYZ rates, I can go to ABC. And I think now if people just giving them advice, ask your person that maybe is doing your loan, or your mortgage banker or broker. Cause like I said, I've been in business 20 plus years, and I've seen the flexibility of being able to shop somebody's loan. And yeah, to answer your question, if I was to compare my apples to apples, my rate with a bank, it's amazing how, and this is what the general public doesn't know, is that a quarter to 3/8 point difference in rate. Like say I'm quoting 3 3/4 and they're quoting 4 1/8. It doesn't sound like a lot from a nominal interest rate, but in terms of cost, it could run anywhere from 4, 5, 6, 7, 8, $10,000 difference, depending on the loan program, on being able to help people. So
And is
that
that
quarter,
upfront costs, or is that just built into the payment?
well, it's really, it could be. I mean, obviously, let's say if I was going up against a bank and I was at say 3 3/4 and at par, meaning there's really no cost. But if I bump, if another bank was at say 4 1/4, say if I bumped it up, it could be $10,000. That's $10,000 in credit that I can actually give somebody to help their loan, their closing costs. So it's upfront costs. So it does make a big difference. So I mean, I think that's I don't think people, the reason I'm bringing this up is the average person really doesn't know. They think, oh, okay, it's a quarter point difference or 3/8 of a point difference. Okay, I'm going to go with Jim Smith or at XYZ company. But if you do shop the loan, that quarter point or 3/8 of a point could make a big difference in your closing costs.
Yeah, so you might be looking at that one bank and saying, "Well, they quoted me 4 1/4, but there's no fees."
Yeah, yeah,
But then you can say, "Well, yes, but I found a lender I can give you 4 1/4, and you can get $10,000 credit."
yeah, yeah, yeah.
So you're going to look at it originally and think, "Well, no, they're not charging me anything."
Yeah.
Here's the question of the day. How high do you think rates will go by the end of 2022?
You know what? I'm Derek. I mean, personally, I guess I don't have a crystal ball. I can just go off of experience. I mean, back in 2018, when it was kind of a tough market, like I said, you can only use take today's information based on that. You look at the past experience of what's happened before. Um, we saw rates rise from I think it was like around the mid 3 range up to around 4 7/8 5. So we saw about a point and a quarter rise back in 2018 when they had the other taper tantrum, so to speak. Um, there's certainly
We
I
got
wouldn't
up
be
to
so
about 4.78, I think, at that time.
yeah, yeah. 4.78, high fours. I mean, there are some people that are tipping probably 5. I mean,
Well, I think what we're waiting for is the inflation numbers, right? The next, not so much next month, but maybe by March.
yeah. Well, they're saying that the March is still going to look bad because you're comparing year over year, and you take off last year's March, you add in this year's March, and it's going to look even. It's going to look, obviously, the inflation numbers the next couple months are not going to look pretty. But I think the Feds are going to look up beyond that. But to answer, Derek's question, nobody's got a crystal ball, obviously, but we're talking high threes right now. If the market was to run, the Feds are obviously, pulling back their mortgage-backed security market. We could see low fives. I mean, it wouldn't shock me, wouldn't surprise me.
By the end of 22.
Yeah, I mean that's just
Yeah, that's
my.
pretty bold. Yeah.
That's my sitting in this room in Chandler. Based on my experience, but I don't. But I think the market always has a tendency to snap back toward the norm. I don't think you're going to see them. If they got out of hand, obviously you'd see the market, the housing market soften up. I don't think it's going to crash. There were times people say, "Oh, we're going to wait for a crash," but
Well, it's interesting. Speaking of that, and I was going to kind of hold it towards the end, but a lot of people in the Phoenix area know a gentleman named Russell Shaw, and I saw an interview of him. He's a guy on television that says, "I'm applying for a job. If you don't like me, fire me."
mhm,
And he came out and said in this interview, he said, "If you're waiting for a crash, you're going to die of old age."
yeah.
And he rolled up a lot of data to explain it. And I'm going to show some of that data in a couple minutes here. We have Jackie here saying, "Happy Friday, you got it."
Hey,
So
Jack.
yeah, it's been interesting. So let's jump into some of that Cromford data here,
Yep. Try to
and
keep it segmented here.
yeah, so it's I want to show kind of the market index and what it means. I want to not so much do a boring deep dive into the market data, but we're lucky in Arizona that we have Michael Orr, who formed the Cromford Report. He's a mathematician and a statistician, and this is one of the only markets in the country where we have a company that does this deep dive
Mhm.
into the numbers. And then he has put together this index, and this index is a predictor of where prices could go. And versus Core Logic, which gives you very accurate information, but it's 3 months old.
Yep.
So that's, what are you going to do with that? So what this guy shows us is an index that said, here's what you can expect in 3 to 6 months. And this is some examples of that. So you can see here how back in 2004 and 5, see how the index was climbing here?
Mhm.
Prices didn't go up until here.
Mhm.
It started coming down pretty sharply here, but
Mhm.
it still took a few months for prices to start following along. So this is an indicator that this is going to happen. Now, we had the crash right here. Actually, we had the crash right here.
Yep.
So then things just stayed below 100. So the number there is 0 and there's 10%. So that's the values, right, of real estate prices. We got down at 43% below the year before. And so
Mhm.
you can see that we kind of muddled along. But then here the market index kind of starts going up again
Mhm.
in 2012, giving us an indication that this was going to
It
happen.
happened. Yeah.
Okay. So now, having said that, here's where we ended up in March, that huge dip right there, right? Stay at home 2 weeks, stop the spread. And then it started skyrocketing up, but prices didn't head up until like March of 2020
Yep.
and then 2021. So right now we were coming down, and those numbers started showing up like September and October. Instead of having real estate going up at 2 and 3% per month, it slowed down to 1.2, and they were showing us that that was coming. But now look, we've curved back up. So
Mm-hmm.
what does that mean? That means that in the next 6 months, Greater Phoenix is not slowing down. Prices will continue to rise through June of 2022. And so in December 21, we had an annual appreciation rate of 27.1. And so days on market to contract, 18 days. There is going to be, if we look at the Cromford Market Index here, boy, it looks just like last year. Now, what happened? The Cromford Index climbed up here in March. May and June was when we saw the crazy numbers,
Mm-hmm.
the bidding wars and everything. Are we going to do that again? The index is telling us that it's 2021 all over again for the first quarter. Okay.
Interesting.
And it's showing here, this is the index by city, that Fountain Hills finally came down. They're in the stratosphere with 100 being what we consider normal. And I'll show you what normal is in a moment. Down 4%. So they're still way up. The only ones that are knocking down on the basement floor are Maricopa and Buckeye, but they're still 247 on the index.
Mm-hmm.
So there is I'm going to pull up another photo here. I think I am. There was a slide that I had that showed, let's see. I'm like you looking for your other screen. I don't want to bore people with me trying to find it. Anyway, going around looking at normal. So this is where what I want to show on that and remind people when we were looking at normal again is there's a report on here that we call extremes. Okay. So Cromford Market, news, information, it's here. Tablet. Gosh, I had it pulled up and somehow I lost it. Anyway, long story short, extremes. The most amount of listings that we've ever had is 57,500. Today, 5,200. The 57,000 homes that we had was excess inventory. At that time, you know how many builders we had active in the market? 400.
400.
400.
Okay.
After the market crashed, we got down to 20. So we had those 20 builders. Nobody did anything for 13 years.
Yep.
So it took almost 60,000 homes out there that people bought, but nobody moved into, for those to come down, the price come down to reality, because they were all wrapped up in really bad loans. Before the Cromford report, there was a guy that was flying a helicopter and taking pictures of neighborhoods and putting reports out. He took a picture of a subdivision down in the East Valley of about 300 homes on trash day, and only 7 trash bins were in the street. So you got 300 homes, only 7 people moved in. Maricopa was one of the worst. You could get a house down there with a pool for $55,000 when it all fell apart.
Yep.
So in order to see a crash, our number of 5,200 right now has to somehow, some way, get up to that extreme number of 57,000, when the normal over the years has only been 27,000. That's normal. So there's a long way to go if you're waiting for something to disrupt us and give us those type of numbers. So that's why I kind of gripe a little bit when I see people that I call crashers talking. And it's like, just because prices are going up fast doesn't mean it's going to turn around and reverse itself. There has to be a catalyst to add to the inventory, because all it is, like you keep saying, simple supply and demand.
It is. It really is. And like you said,
what is normal anymore? Over the past 21 years, we've been in the buyer's market for 3.6 years, a balanced market for 4.6, a seller's market for 13 years.
Hmm.
So here you got 21 years of data. We've only been in the buyer's market for less than
Right.
4 years of that. The longer the seller's market lasts, the more human beings change their definition of what normal looks like and feels like.
Yep.
So right now, normal in your world is mortgages in the mid threes to low threes.
Yep. Yeah.
That's
That, and
considered.
that's exactly what, you just hit on the nail on the head when, when rates go up, people get this. There's about a 1 to 3 month shock period where people people when they're in the 2.5 to 2 3/4 range, we sat in that range for, let's see, 4 or 5 months, give or take. Then when you see it go up to three, there's a little shock. People get normalized. Then we went up to 3 1/8, 3 1/4, 3.5. Now we're in the high threes, touching the 4% range, and people there's that 1 to 2 month period where people, because the average person, if they're not following rates, and the last time they saw rates were high twos, and all of a sudden I think that's where people start shopping, because some of these people like, oh yeah, your interest rate's 4%, like 4%. I haven't
Yeah.
heard 4%, and
Oh,
so that's rates get normalized too, just like the market, the supply and demand.
yeah, Tyler, I'm trying to pull up Levine here for you. I can look at active listings and see. Let's start there. And if I pull up the city of Levine over here, um, and did I go? There it is. So taking supply and demand into consideration, here's Levine. Um, the blue line here is 2021. The brown line's 2020. And last year at this point, we had 31 homes. We're at 38. So we're just mirroring last year.
Yeah.
That's
Yep.
going to put you in the probably high fours, mid fives in the Cromford market index. But you definitely still continue to have an inventory shortage. Here's what happened April 4th in 2020. You went up to a high of 70 homes. But the story for Levine, though, is that these are resale homes that are in these numbers. So there's a lot of building going on out there. So it's a totally different market to analyze.
Yeah.
Builders, again, are behind. They're trying to build more and more homes, and they can't get any help. So they're behind the eight ball. So it's
Well, there was a
you
number
show.
that came. I can't remember. There was a number saying the new home starts. There, I saw this one. I'm just generalizing, but it said that new home sales are down from last year to this year, down expert. I think it was 10% or some number. Basically it wasn't nothing because of if you read once again, you go back to the headlines, you read the headlines, it's like, oh my God, sales are dipping, basically because of supply. We can't
Yeah,
find the workers to build the homes.
you just can't get in less than 18 months.
Yeah.
Let's put it in perspective with this. Here's the Cromford Market Index today. Here's that where it was in 2020 or 2006, 2007. Down here on
So
the bottom. An
yeah.
index well below 100. I can change this up here just a bit. You can see that it's in the 40s
God,
down here.
it's
34,
amazing.
46, right? So what did it look like before things went to hell in a handbasket? So here's the green line. The green line where they got to a high of 312 and then got down to a low of 86. So right about here, as it's climbing down and it got down below 100, this is when the Cromford report people were saying, um, it's looking bad, folks.
Mhm.
It's looking really bad. And nobody was paying attention to it. Does the house age affect its appraisal? Depends. What have you seen, Pat?
Uh, not not so much. I really have. I mean, obviously, the biggest is if you had a manufactured home.
But you're
Uh,
comparing the age of that house to other homes of that same age.
yeah, exactly.
So
Yeah.
a
So
96 to a 96.
yeah, you compare it. Yeah, you don't compare a '96 to a 2010 built.
Right. Yeah.
So appraisal doesn't really affect it because you're comparing like properties.
Probably gets a little tougher when you get into the historic areas like
Oh yeah.
Melrose and Coronado. And so that might be a little tougher. There's a question here that came up. It's on called Scouting Report. And they actually talked to Tom Ruff and to Tina Tambor, the Cromford Report. Tom Ruff's another guy that's very accurate. First, let's jump into Derek here. Should people take equity out of their homes now in order to lock in the current rate, or does it make sense to wait a year or two and risk a rate spike?
Um, I'm a big fan. I mean, let's see, does she take equity out of their home now? It depends. I mean, if I get here, stop my thinking here. If you're at 2.75%, 3%, I am not a big, because a lot of mortgage people are saying, oh, the big next move is going to be debt consolidation where you can, refinance people. But economically speaking, if you're at 2.75%, 2.875%, 3%, and you got to go to say, leave your first mortgage alone, get a HELOC. I think don't mess around, because a lot of mortgage brokers will say, okay, you owe 300,000 on a house that's worth 600. If you want, to take $150,000 out, they'll refinance the whole block at the higher rate.
Gotcha. Yeah.
I'm not, I mean, I've seen mortgage brokers, or mortgage people say, oh yeah, I can refinance you and consolidate your debt, pay off $50,000, $100,000, whatever of debt. Leave that one section, the biggest portion of your mortgage that's at a lower rate, leave that alone. And, get a home equity line of credit. Yeah, your interest rate's going to fluctuate. It's interest only, but I'm not a big proponent of refinancing the whole block of your mortgage at a higher rate, because I don't know. That's me. I mean,
Yeah.
if you got low rate, keep it there.
Jackie gives us another answer on appraisals here and said, unless in my horse properties, where do you expand age and make adjustments? So that's a whole different market out there. That's probably has a lot to do with, you're looking at comps. So, Jackie knows how comps are, that, they'll say this house is newer than the comparable property. So we're going to take, 15,000 off of that. There's all these adjustments that they make. And so some of it boils down to age, but then it's like, well, how big's the lot? Does it have a horse barn? What are the amenities? So that's complicated stuff. Here's the question that came up, said, how low can listings go and prices rise? In December, there were 8,640 homes for sale across Metro Phoenix, according to Armless. That's a 21% drop from November and a 12% decrease from December 2020. Tambour said prices could climb 1% or more a month this year. I think we're going to see them climbing probably 2 and 3% in the next 2 months. During the first half of last year, prices climbed about 3.2 a month. Now, remember I showed you that index and we're butting right up against it at the same time of year?
Mm-hmm.
That's why I'm saying 2 or 3%. According to Cromford, but when the supply of homes for sale started to climb last summer, price increases fell to about 1.3. And that's where we saw the index start to come down. That's when prices started to come down. The Valley's median home price climbed $95,000 in 2021, but their bottom line is they're saying we begin 2022 with the lowest number of active listings at year's end on record, said housing expert Tom Ruff with we call this Armless, Information Market Research Group. He said the big unknown that could affect the housing market this year includes inflation, rising interest rates, and Wall Street's home buying spree. I couldn't agree more. Wall Street is a big impact right now on our market, and especially in the entry level price points. I mean, my phone blows up every day with investors. Rick, what do you got for me? We'll pay cash, anything. They're almost 30% of our market.
Yeah. Wow.
So if that changes, Pat, and they decide to back off because the math isn't working, how high do you think that's going to push inventory out? Because I don't think it's going to push it up very high at all.
No, I don't think so. I think any opportunity that somebody's got, once again, I think it goes back to the thing that I've been talking about the last year, is just supply and demand. And, we've been underbuilding for like the last 10 years. We've had those charts. And that's, like you said, I don't see this slowing, at least for the Phoenix market, because we're just underbuilt still. People are moving here.
Yeah, it's so if we're going to look at trying to figure out where this upcoming year's coming, and you're a buyer and you're waiting for the bidding wars to calm down, We're going to have a bigger gap in the 7-day moving average between homes that are coming up and homes going under contract. Those numbers need to switch.
Mm-hmm.
The one I
Mm-hmm.
show you today shows you that the homes going under contract are greater than by 800 units than the homes that came on. So
Yeah.
that has to reverse itself.
Yep.
Once you start seeing that reverse itself and it starts getting sustained, then we can head towards a more balanced market. But to get to a balanced market, that's going to take some time. And in the middle of that, um, the news is not going to make you feel like that's a comfortable time to write an offer, because they're going to have things like inventories up 15% this month.
Rates are up.
Rates are up. It's all going to be negative news, but it's going to take negative news for everything to balance down, to
Yeah.
balance out.
Yeah.
I
I
mean,
think
if, right? I mean, just general psychology. If we can,
I was looking at a chart, and I'm not going to pull it up, but I was kind of comparing 2018 the other day to now. And I mean, if I was just a step back, just being Pat McMaster's mortgage guy in Chandler, I mean, looking at the whole swath of news, I think, this is just, it's going to be I think this whole year is just going to be one of those, feel like you're walking through mud the whole year.
yeah, it's hard as an agent too. It's really, and people are like, oh, you guys, you're just trying to do FOMO, fear of missing out, and you're pushing so you can get those giant commissions. You should look at how much real estate agents have to work where they don't make a darn dime, especially in a market like this,
Yeah.
because you're driving, you're showing the home, you're pulling up the comps, you're writing an offer, it doesn't get accepted. So next week you go do it again, you do it with two more people. And so when
It's a lot
inventory
more.
gets really tight and it's bidding wars, you're not writing checks every day.
No,
It's
no.
tough for realtors out there. And it's the average realtor right now in Arizona makes $43,000 a year. You pull up the data from last year, you'd be shocked at how many only sold one home. And there's a lot of different reasons for that, but
Yeah.
it's really tough. I'm rooting for us to somehow get towards normal,
Yeah.
because this party right now is not fun. I keep swinging the bat. I'll keep trying. And, but when you get these cash investors that come in and swoop in, it gets tough. Now in Jackie's market, she's in the, the horse property stuff. She's not running into as much of that as she does, going down in the, the 400 to 500,000 range where you have the buyer beat down.
Mm-hmm. 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 And she made a comment. She had numerous buyers that are believe a crash was coming. I mean, like you said, I mean, these people, if you take an extreme view and say a crash is coming, you've been burned the last several years. And I mean, yeah, but, like I said, people have to, what's gonna, what I just don't see. There's nothing out there that says crash. I mean, and the thing of it is, once again, people have to look at their finances, see where they're at. But if you minimize your down payment, people have to realize, yeah, if you buy a house for 400 and it decreases, if we see a decrease of say 5%, that's what, $20,000. I mean, and if you put 5% down, if you're putting $20,000 down, that's really what you have to look at, what you lost, from the money standpoint. People people, they theorize and they like, oh, we're going to see a crash. Like you and I have talked about the last couple of segments, just because we saw a crash in 07, 08 doesn't necessarily mean we're going to repeat that. That was a crash of a lifetime.
Yeah, nobody had any skin in the game either, Pat. They hardly put any money down. It was an adjustable rate to fix. It was easy to walk away because they weren't leaving any money on the table. Nobody's going to walk away from their homes now. They have too much equity.
There's
now 3 years from now, maybe all that changes. But for now, I don't see it.
The housing market increased by $6.9 trillion in 2021. It's a total in terms of mortgages. It's the most in any year. There's $43 trillion now in real estate out there. That's a lot of money.
Well, I'll tell you a market that's really starting to go nuts in Florida and Arizona, where investors are starting to pay a lot of attention, is in over 55 communities and park model homes.
Yeah.
There's communities like this one called Treehouse that operates aggressively in Arizona and Florida, buying these places up like crazy, putting in these little park model homes that are under 800 square feet and beautiful communities, and they're scooping them up like crazy and just collecting the lease payments. They
Yeah.
see a good return on investment. Why? Because we're getting older, and
Yeah.
we want to get into something like that. And so, there's opportunities that could come up to where maybe more baby boomers gravitate to something like that, and it eventually starts to free up inventory. But there's there again, I want to stress that when those numbers start showing up, it will be viewed as a negative trend when in reality, it's going to be an opportunity for you. How many people thought 2012 was a good time to purchase a home?
I'd say two out of 10,
Yeah.
3 out of 10.
Well, because you had to go in and put in a new air conditioning unit because somebody ripped it out. There, half the plumbing was gone. There were holes in the wall. So homes were going for like $39 a square foot. Why would you want to buy then?
Yeah. Yeah. Exactly.
So it's mentally, it's getting back to that chart is where this conversation started. People get a different perception of normal.
Yeah. Yeah.
And so when prices are going up, 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 it's easy for us to say that's normal. When the numbers start turning and it looks like what we perceived as normal is changing, we view it negatively.
Yeah.
And it may be just taking us to a balanced zone. So it's something to watch this year. And we're going to see it here. When we get a sea of blue of listings above the contracts,
Hmm.
it's a game changer.
Yeah. And it's got to be
Any
sustained.
thoughts on Airbnb demand in the valley? I'll give you my thoughts. Um, it's strong, but I think it's hard to be both understanding the real estate industry and being an expert at tourism at the same time. Uh, I can't get a Cromford report probably can looking at short-term rental properties, just how many are here, but I don't know. I think it's getting pretty saturated.
Yeah. Like you said, you gotta juggle the real estate market and the rental tourist side of things. That's a lot to handle.
Yeah, I mean, there's a it doesn't take much. Just look at spring training in March. They just shut it down. And these people bought three of them, and you can rent out in March. From March till middle of April, and you've made your entire year there. Do Vegas says there's so much new wealth from stocks and crypto, also side hustle YouTubers. Yeah, I'm killing it. TikTokers, amateur athletes getting paid. Um,
Yeah, there is a lot of loose money out there. I mean, that certainly could have, that's something probably, that there has been a certain wealth effect created by crypto and all this, the market trading. There's a lot of day traders out there.
Yeah, and I
That's
hate to
something.
use that word here because guarantee you, in my comment section tonight, one guy will come on and say, "I've got a manager
Yeah.
here that," and
Yeah.
then 19 people chime in. I get in and I delete him every time because it has nothing to do with it's just spam. Towner said moved to Queen Creek Santan area 2 years ago and it was quiet. Now traffic's crazy. 2 years ago the traffic
I
is
know.
crazy because it was only 2 lane roads. And not all people can buy, but there are plenty that can. There is, and I feel bad for the people that can't get in the market. I really do. It's disappointing to see you write an offer for somebody that's really excited and hoping they're going to get that home, and you're just on the phone with that agent. You reach a point where you can no longer meet that price, and
Yeah.
then you got to make the call.
Yeah.
And it's terrible. It's like bringing a bad grade home from school to your parents. It's like
Yeah, that's what, one tip that I can give people that are out there looking, as I mentioned this a couple of, maybe viewings a couple weeks ago, is that TBD, to be determined pre-qualification. That I think that definitely would set you apart. I mean, basically what it is you're going through the underwriting. There's like I said, there's a handful of lenders out there that allow me to submit pay stubs, bank statements, um, W-2s, everything in a file. And basically you are basically underwritten by an underwriter. And all you got to do is go out and find a property and get the appraisal. So that might be, certainly if you're an
that's a
agent.
great point because it's anytime you submit an offer and it's contingent upon financing, you're still waiting for the appraisal and you're still waiting for underwriting.
Yeah.
Um,
So, I mean, if you can do the TBD, like I said, it's called to be determined, property to be determined, I think that would give you, that might give you that one leg up on one property where,
Yeah.
somebody, an agent says, okay, you have been through the underwriting process. This is not going to be the financing. Even though you're getting finance, it's still not going to be a problem. All you got to do is get the appraisal. And obviously appraisals have been coming in strong. There have been a few that have been, we're getting this period too, this normalization where, we saw this, correct me if I'm wrong, we saw the sellers getting really whacked out on prices. And, there was a period, correct me, my memory corrects me, or serves me right, that some of these buyers are like, I'm not paying $50,000 over, you know?
Yeah. Yeah.
So, I
We
mean,
have a question down here on HELOCs. Can you explain them briefly?
um, basically it's just, it's called the home equity line of credit. I mean, it's, typically the home, like they're written by most of the banks, the banks love them, like credit unions love them. If you want to look for a HELOC, I typically recommend people going to a bank. I mean, I can do them, but it's HELOCs are kind of clumsy on the mortgage banking side. So your typical banks like Bank of America, your credit union like Desert Financial, other like Washington Federal, um, they'll typically go up to, it's just basically a credit card. You got a first mortgage. Let's say you got a $500,000 house that you owe $100,000 on. They'll typically, HELOCs will go up to 80%, 75, 80% of your value of your house. So it's just a second. It's really technical. A lot of people don't realize I see this all the time. People say, "Oh, I got a first mortgage," and then I look at the credit report and I'm like, "Well, you got a second mortgage." Well, that's just that's a line of credit. It's still considered a mortgage on your loan.
Yeah. Yeah.
It's a
Oh, yeah. That.
yeah, oh, that thing. I owe $50,000 on the home equity line of credit.
Yeah. Yeah.
Basically, it's a mortgage. If you take out a home equity line of credit, say for $50,000, you could pay it down. It's interest only. You could pay it down to 10,000. You still have 40. So it's a flexible. It's kind of like basically in a nutshell, a credit card,
Yeah.
a second mortgage credit card on your home.
Derek's asking about second homes up in our mountain towns, Payson, Prescott, Happy Jack, Strawberry, and Pine. Well, I guess we're kind of in a wait and see mode because of the second home fees that are getting layered in.
Yeah.
So we're going to have to just watch that. I mean, the last thing that they put in trying to tell lenders to restrict it fell flat on its face. This may be a little different. It could, will it slow things down? The catalyst that made those places do so well was people could work anywhere. And so they went out and grabbed a second home so that they could have an office, not in the valley. And so, maybe that party's not over yet, but I think we might see it start to slow down a little bit.
I think there's going to be an effect on it. I mean, because I priced out, what the difference would be. It basically take a rate from say 3 3/4 up to 5, 5 1/4. It raised, I'm just giving general terms, but I think it would raise the general person's, if they were looking at $350,000, $400,000 second home, about $400. And my feeling is people that are looking at second homes are not as financially stretched as your first time home buyer. They've got the financial means to kind of weather a $300 or $400 difference in payment. And they're buying, to me, second homes are more of a luxury, luxury item where like, hey, we can afford this. We're gonna buy a
some
second
people
home.
buy them with friends too. So there's two
Yeah.
families buying the homes and then they split it up. So
Yep. You see
that's
that a lot. So
doable.
it's going to be interesting to see how that interest rate, I think it's going to be, I think that's the FHFA, the, housing authority, they're trying to do this to, I think, curtail second home buying. I think it's, to me, I mean, from what I can read and gather, it's kind of an experiment and it's something that they could pull back right away. Cause I think you're going to see, some pushback from the mortgage industry saying this is BS. And, sometimes when we push back, cause we pushed back on that second home fee last time and they rescinded it. They pulled it back. They're like,
Well,
okay,
remember, we're from the government. We're here to help.
Yeah. So, but
Do Vegas here said he bought a house in Ahwatukee in 2006. He was underwater for 14 years, but he didn't move. So you're probably doing great right now, right?
Yeah.
So if you're trying to treat housing like a stock market, you're bound to, you're taking a lot of chances. But if you buy something with a fixed rate, stay put, take advantage to refinance it when rates go to record lows. It's a good, solid plan. If you're only planning on being in a house 5 years or less, you're rolling the dice.
Yeah. I mean, rents are now, you're going to rent. People need a place to stay. Either you're going to rent. Rents are fluctuating every year. I mean, I saw some on Facebook. This one person was commenting that has to move out because her landlord is raising her rent by $1,000 a month.
She'd probably been in there for years.
Yeah.
I know my son has a condo he's renting, a 1-bedroom, nice place, $750 a month. I'm not going to tell you where it is. We saw it and pounced on it. And I saw it on the MLS and I go, you got to fill out this paperwork. Yeah. He says, yeah, I'll get it out in the morning. I go, no, you got to fill it out now. I want you to get it back to me within an hour. And I'm going to call the agent. And the guy didn't want a college student. He says, I want somebody that's a hardworking young kid that is reliable. And I don't want a college kid because I don't want him coming in and out and in and out. And he hasn't touched his rent. He's on a month to month with $750 a month. The landlord says, don't worry about it. Yeah. That's rare. That's rare.
That's rare. So
Steve says, what about DPA programs? Will we see a run on those again in the rural areas?
We haven't. I mean, the DPAs are around. You can talk from this perspective.
People don't know down payment assistance, right?
Down payment assistance programs. Yeah. I mean, they have not been popular on our side because from your side, if you're an agent, you see somebody who's rolling in on an offer on a DPA, 9 times out of 10, those offers are not going to be accepted.
It's hard to compete with those. It's hard to compete with FHA.
Yeah.
And, FHA, you can get knocked out at the last minute just with a home inspection.
Yeah. I mean, to be able to get a DPA done, from what I've seen it just by luck. You run into a property that, somebody's got a soft heart. The seller's got a soft heart and gives the people time to get the DPA done because they typically take about a week and a half, 2 weeks longer in underwriting to do. And they're not free. I mean, the problem is your rate, just a general overview on that. I mean, if your regular rate's 3 3/4 on a regular loan, your down payment assistance rate is going to be high 4s, low 5s, 5 1/4. It's not free money. So
yeah.
So,
well, it's tough. Well, I appreciate everybody hanging in there with us. And like I say, we're changing the format up. You can expect exactly what you saw today every Friday at 3:00. Until then, Pat, have a fabulous weekend.
All right, people, have a good weekend.
Come out and meet Ringo this weekend.
I will. All right. Take care, everybody.
Still alive. See ya.
Bye-bye.